When activist investors start getting involved, I get quite excited because it makes me wonder if there's a juicy opportunity just lying in plain sight. And that's why I got interested when I saw that Starboard Value was getting involved with GoDaddy Stock, GDDY, sending the stock higher. Let's dive into sort of the thought process here and what does GoDaddy do? If this is your first time tuning in, my name is Daniel, and you're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in GoDaddy. GDDY is the ticker. So earlier today, GoDaddy stock jumped 8% plus on news that activist investor Starboard filed a 13D disclosing a 6.5% ownership stake. The 13D is the filing that you use if you're saying, hey, I'm going to be an activist investor and I own more than 5% of the shares outstanding. Given that the stock performance is flat year to date, there's a good chance that they think there's significant upside from around the current levels. So let's dive into GoDaddy, their current operations, and an opportunity to see what Starboard and other shareholders might be playing for. So while GoDaddy started off as one of the largest sites to stake a domain, they're looking beyond this increasingly commoditized business and thinking about bigger markets, like enabling one's online presence with, let's say, a WordPress partnership that they have, and branded email and marketing, business applications. For example, they're an Office 365 reseller. And the real honeypot is commerce. So while the domain registration business might be thought of as a legacy stale business, the reality is that it's still nearly half their business. This is talking about GoDaddy with strong retention rates. Year to date, this business is actually up 17%, driven in part by strong aftermarket sales. So that means markups on domains already held, and from acquisitions of smaller registry operations like from Newstar at the end of last year. After spending billions on advertising cumulatively over several years, with lots of spicy Super Bowls commercials, GoDaddy is also one of the most recognized brand names for domain registration. They hold over 22% of the domains registered worldwide, which would arguably lead to some real cost or scale advantages. And that's part of the reason why they arguably become an acquirer of smaller registry businesses. This could also lead to a significant advantage with upselling higher margin services. So it's an advantage to own the top of funnel. They have this, brand recognition. Oh, okay. Come for the competitively priced domain registration and stay for the site design, the email, and other core functionality like commerce, which can be a higher margin upsell for GoDaddy. So in addition to domains, they have the hosting services, which has about mid-single digit growth since 2019, and business applications like I already mentioned, Microsoft 365 reseller, email, etc. Enabling commerce is also a top priority for GoDaddy. Just this past year, through M&A and organic investment, they launched payments functionality as well as physical point-of-sale devices. So this is really about getting a souped-up website, not just getting basic domain registration and setting one up. As of the third quarter 21, their annualized gross merchandise volume across the GoDaddy ecosystem was around $25 billion and growing nearly 30% year over year. That does strike me as an attractive start. But for context, Shopify was or is about 6x their size, so significantly larger in terms of the gross merchandise volume going across their platform and growing closer to 50%, so growing faster and much bigger. So yes, they're still very early on in this. That said, there's clearly a lot of opportunity here. Many players can win, and there's a chance GoDaddy can be in a favorable position at the top of funnel, as I've mentioned a few times. And I think that really is their strategic advantage that they might have against a lot of these other resellers or sellers of additional services. The fact that they can layer these additional things on, that can be really incrementally positive, margin contributors. That can be a real advantage. So why is Starboard interested in the first place? Starboard. So first, a quick plug, where if you're interested in following along with my personal financial journey, go to unrivaledinvesting.com, where each month I call out potential multi-baggers, as well as my personal portfolio. We also have an exclusive community dedicated to learning and trying to find exceptional companies on Discord. So if you're interested in checking that out, go to unrivaledinvesting.com, click join the journey. And if you enjoy videos like this, please make a point of hitting that subscribe and thumbs up button. So why is Starboard interested? The short answer is that GoDaddy is a free cash flow machine with a long reinvestment runway at a reasonable valuation, trading around 15 times free cash flow. What makes them such a cash cow is because they're relatively sticky. 85% plus annual customer retention each year, 93% for customers that have been around for 3 years. So this is fairly reliable, sticky business, and they have literally millions of customers willing to pay them hundreds of dollars. 1.4 million customers paying $500 a year. So that's very successful reselling of additional services beyond just being a domain registration, saying, oh, let's layer in this additional core functionality to this website. Another way to frame it is management expects to have over $5 billion in deployable capital within the next 3 years. So the way to think, how do you get to that, $5 billion plus in deployable capital if your free cash flow is only around $1 billion a year, is so you get around $3 to $4 billion in free cash flow from, let's say, some organic growth plus the accumulation of that $1 billion a year. Plus, let's say you add on another $1 billion in additional leverage, so additional debt. And so, saying, okay, $5 billion plus, which relative to their current $14 billion market cap is quite interesting. I mean, the back of the envelope is around a 35% return over 3 years without any benefit from valuation expansion. So, that is kind of interesting. Management has also already started returning capital to shareholders via buybacks with the $250 million buyback in the third quarter at $73 a share. Now, the stock's in the 80s, that was a reasonable purchase. So the $1 billion question is whether management will make poor use of this capital in the future. And arguably, this is a core component of why Starboard is taking an activist role. They want to make sure that the $5 billion in cash is allocated intelligently. I'd argue the playbook from here is get a board seat, make sure they don't overpay for mergers and acquisitions, looking at this e-commerce aspect or commerce in general. Consider optimized margins. And this is a component that I need to think more about with Starboard. If anyone has a strong take on it, I definitely want to hear it. Maybe they'll come out with their own presentation in time. But there is the potential that GoDaddy could have much higher margins in the future. I'm curious if there's more to squeeze here in terms of greater profitability, because the reality is the free cash flow margins that they're targeting include a significant amount of stock-based compensation and deferred revenue versus pure profitability. And so it makes me wonder if they're going to come at this and say, hey, you could potentially lower your core costs somehow. And, I don't have a strong opinion on this, but currently on a GAAP basis, they're only reporting, like a low teens operating profit. Now that does pass straight through to the net income because they have significant tax assets to the tune of several $billion, so they don't effectively pay taxes. So there are these different types of considerations. And I'd say the last key component is potential strategic options. One of the core options usually considered is to take GoDaddy private again. Now in 2011, it went private when KKR and Silver Lake bought it for around $2.25 billion. Now that is significantly less than the current market cap of around $14 billion with an enterprise value of closer to 20 or probably a little under $20 billion. So the question is, what's the potential private market value for GoDaddy? Could, let's say, the equity be worth 20 times free cash flow or about 25% premium from here? Could it be worth 25 times free cash flow or 60 times or 60% premium from here? Arguably, in a takeout, they could possibly layer on an additional maybe $2 to $4 billion in debt. Generally, when companies are private, they can have much higher debt multiples. So maybe an LBO would still require, even in that situation that it gets taken private, where they raise an additional $4 billion in debt, given that they already have several $1 billion in debt, just to get that 20 times free cash flow takeout or 25 times free cash flow, multiple, you'd still need to write a huge equity check of, let's say, $15 billion plus. So I'm not sure how likely that is, how many players are actively looking to write checks that size. So it makes me wonder if Starboard is really in it just for the long haul and trying to say, hey, we're going to play the right game to make sure they grow at a good rate and, look to optimize margins. I honestly, looking at this, I don't have a super strong opinion on it from here. I like looking at, strongly cash-free, strong free cash flow companies with a good growth trajectory. And I think you definitely have this here. I think being top of mind for a lot of folks when they say, oh, I just want to register a business, they go to GoDaddy, there is that potential that they can continue to upsell these higher margin services over time. I don't think they're necessarily unrivaled. I think they have a reasonable or strong value proposition. Maybe they grow at an increasingly accelerated rate as they layer on additional solutions that potentially grow quickly, like commerce. But I also wonder, can they actually win longer term against the players that have committed so strongly to e-commerce already and are growing faster, like Shopify, and are bigger. And so that's sort of the questions that I'm having looking at this. I'm very curious if Starboard ultimately does come out with some sort of presentation, articulating what they think the upside downside is, because I could see why, and this is why I get excited when I think about this. Is I'm like, okay, at this point, it's really the odds that the company does something really dumb at this point goes down significantly, because the pressure is going to be on to return capital to shareholders and make sure you don't significantly overpay from here. So then it's just like, okay, so what's sort of the return profile from here? And I'm thinking to myself, should it dramatically warrant a higher valuation than, let's say, 15 times free cash flow? I'm not really thinking, yeah, it should, especially when that free cash flow, I'd argue, is arguably inflated because it includes stock-based comp. I'm using their figure for cash flow. So then the next question is, can they squeeze margins? And I don't have a strong answer on that. But if you have a strong answer or a strong opinion on GoDaddy, I'd definitely love to hear it in the comments below. And also, if there's an unrivaled company that you want me to take a look at, please leave a comment in the comments, just because I want to learn more about what are the unrivaled companies out there. So not only the company, but why you think it's unrivaled. If this video talking about the recent activism with GoDaddy Stock, GDDY, has been helpful for you, please make a point of hitting that thumbs up and hit subscribe button. Thanks for tuning in.